Hi everyone, welcome back to today's episode. We have Osbourne Foreman. He's a stock market investor and YouTuber. Thanks very much for coming on.
Much appreciated, much appreciated. Hopefully, it'll be a good, impactful episode today. We'll get through quite a lot.
So, do you want to give a bit of a background to how you got into the stock market, and like what inspired you to start posting YouTube content as well?
Oh, okay, that's quite an interesting one. So, to actually inspired into the stock market was probably when I first started working. So, I started actually in a pub and I was doing a few shifts here and there, and I was starting to wonder what best I could do with the money I was getting. So, I think I was earning something like 100, nearly £200 a week. So, not really that much in the grand scheme of things. But I was kind of sat there thinking, okay, right, I'm earning £200 a week, but this isn't the sheer wealth I want to amass over time. So, what can I do with this money to hopefully benefit myself in the future? And I started doing a lot of research. I came on something that required, and it was called matched betting. I don't know if you know what that is, but that was a topic that got me a little bit interested. And I did that for a bit, got banned from everything, and then kind of moved on. But it was a great stepping stone there where I was like, okay, it's possible to make money online using money I already have. What can I do? And then it drew me on to like investing and investing in stocks and shares in particular. So I think in about 2019, about 4 years ago now, maybe a little bit longer, I was kind of just sat on my bank, and I think I was with Santander at the time, and they had like this investment asset manager or something, and it was pretty much my first way in. I just bought a couple of index funds and thought, okay, these index funds seem okay, but what can be done here? What strategy could be adopted to perhaps do better than the annual average performance of these funds? Because there's a lot of disclaimers out there that say, okay, a majority of people actually or fund managers underperform the markets. What can I do as an investor to perhaps beat that strategy? Which is kind of where I got down the line. And then linking that to how I started YouTube, I think for the best part of 10 years, I've been wanting to do a YouTube channel because it was literally the only platform I used. And I've had a few channels over the past, different niches completely. And I think this one really just set a good tone because it was not only something I was interested in, but something that I was able to benefit myself with long term as well as obviously the community in that aspect. So by sharing my own portfolio, the mistakes or the successes that I have, I hope that the people watching could learn from my mistakes or my successes and adapt their own strategy to sort of improve things going forward. So that kind of sums up really how I got involved into it.
Yeah, I think the one of the like most unique things about your channel is the fact that you're like sharing your portfolio in almost every video and
Mm,
very transparent with numbers. Do you think that is like a danger of like the YouTube scene of like people not being transparent?
100%. It is a massive concern overall because a lot of people can just fudge their numbers or go, oh, here's my stock spreadsheet and here's how much I'm making. And they'll start going on about, oh, this is my strategy and here's my course, buy this, for instance. And effectively, I think the only real thing that you can rely on is that person and that brand. So if I look at an individual online, I've got to go, okay, who is this person and how reliable are they? And if they're unable to even show their own portfolio, how can I really take any value of what they do and the approach they take? So it's a case of really sitting down and understanding in depth really how best I can identify that this person has value. And it's really, in that case, seeing what stocks they hold, I find. And by seeing that and having that transparency and accountability, I think that there's a huge level of, I think it's not respect, but it's kind of like people appreciate that you're showing your own skin in the game and that you're not trying to hide the losses. So I think as a whole for a community as well, I think they appreciate the transparency. And I think really the reason I do that is because that's exactly what I wanted to see in a content creator. I wanted to see someone that created videos on YouTube that said, here's the strategy, here's how much I exactly I'm earning, my salary, my job, here's my stocks and shares that I hold in this portfolio, and here's how it's gone. By knowing that, I could then make my own detailed analysis or create my own conclusion from what their results are and kind of move forward in that regard. So I hope that clears things up a little bit there.
Yeah, yeah. Well, what was it that pushed you down more of a stock picking route, and how did you kind of develop your strategy? Was there like a mentor or a famous investor that you kind of looked to and took inspiration from when you kind of started learning about like managing your own portfolio rather than
Hmm.
like rather than just going with an index?
Yeah, so it was probably actually other YouTubers that kind of inspired me to do that more than anything. As I say, I kind of got to the point where I was like, okay, these index funds can achieve an annual average return. Historically, they've done that over a 30-year period. But I really wanted to do better than that. I wanted to create more wealth with the money I invest. So I figured, okay, if the majority of people can't do that, there's still a chance that someone can. So what can they do that the others aren't doing? So I was kind of looking at, let's say, YouTubers in particular. I think Joseph Carlson's a good example for that, where he had his own portfolio online. At the time, I think he had a dividend growth strategy. I've not lately seen his content, but he kind of said, right, here's the 40 or 50 stocks I hold, and here's how my plan on sort of creating a passive income portfolio. And I think really that's where I started. And I was like, okay, for individual stocks and shares, I can pick companies with good dividend histories, dividend growth rates. And it kind of gave me the premise that I looked at the FTSE 100 as a whole and I thought this is overall quite low quality due to the high weightings in old world businesses such as banking, tobacco, oilers. And I thought, okay, well, if I'd have set back and I've gone through this FTSE 100 and went, okay, what are the best quality dividend payers there? And I was looking at companies like London Stock Exchange Group, Halma, and businesses such as that have rich dividend histories with good growth rates. I believe that by identifying the highest quality ones, that you could sort of go and rule out a lot of the rest that perhaps aren't as good quality. Although a lesson I'd learned from that is that valuation is also a critical concern when taking into account these companies. So a lot of these old companies are fairly low on valuation if we're talking price to earnings. But when you look at the companies that are obviously with rich dividend histories, go back to Halma, for instance, they're trading at quite a premium. So it means that by obviously purchasing shares of that, there's a little bit of a higher element of risk, which I've particularly learned through some of my holdings in the portfolio. But I hope that sort of clears things up in regards to how I sort of created or started moving from index funds to individual stocks and shares, started with a dividend strategy in hopes to maximize that income stream, and then sort of appreciated the idea that if I'm going to be invested for the very long term, potentially even life, it doesn't make sense to be drawing down too much of an income now. And I kind of looked at businesses with long term growth potential and ones that kind of excelled in that market, or so I thought at the time. But yeah.
Yeah, do you think maybe because of your age, you're more looking towards growth because you can take a bit more risk, like myself, like looking towards more high growth rather than playing it safe, as you say. But I think I've had out of all the guests I've had on, we've had people with different opinions on whether being a stock picker is is possible to beat the market in the long term. Do you
Mm-hmm.
think that it is possible to beat the market over like a 5, 10 year period?
I think so. Over a longer term period, I do think it's possible. Obviously, my track record so far indicates that it's not, but I hope to prove that one wrong as time goes on because it's only 3.5 years in at the moment. So I'm hoping by, let's say, the 10-year mark that it is very successful in that approach. And when you mention, for instance, at a younger age, what sort of approach and strategy you take, I think as a younger individual, someone that is able to take on more risk. For instance, in my unique situation, I have low overheads because, for instance, I'm still living with my parents. So it gives me a chance where I'm not having to worry about rent or mortgage payments. I've obviously not got any kids yet. So it kind of means that the risk is on myself. And it means that I can take on a greater amount. So by identifying companies that perhaps have less of a proven track record in terms of consistent earnings growth and revenue growth, but actually have potential for higher levels of growth than the average, let's say, more mature company, it kind of, I believe, gives an advantage in that space. But again, comes back to valuation. And that's really where it's critical, I think, in identifying not only a high growth company, but a good price. So that then you can obviously take on that risk tolerance or that advantage you have as a younger individual and being able to invest for a longer term and being able to sit it out and just keep buying here and there and building up a cash position and keeping an eye out for opportunities. But yeah, definitely, I do think that at a younger age, someone should be looking for perhaps a higher risk strategy. And that might just be in terms, and it really depends actually on how an individual copes with risk and how they can stomach volatility. So in my mind, if obviously you're concerned, you're getting stressed out from seeing stocks and shares go up and down every single day, then you might be better off on a passive income or a passive index strategy, for instance, where you've kind of bought a Vanguard fund that tracks the global stock market. You can kind of push that to a side not worry about your investment strategy and focus on other core aspects of life, I think that could also be of value. And at that point, I'd want to be invested in, let's say, 100% stocks and shares or equities, because I think that's the better risk reward balance over the longer term compared to someone, for instance, that's, you know, trying to just buy loads of bonds in their funds at a younger age. I don't think that's probably too worthwhile. But yeah.
Yeah, yeah. What's your long-term goal that you have in mind with investing? Is there like a financial freedom age or number, and how do you plan on like to keep growing your portfolio to that point? Is it that you want to be, able to retire early at a certain age, or is there like a goal in mind that you had planned when you started invested?
This is a really good question, actually, and I think it's quite interesting because the goals I had when I first started are different to what I want now in that regard and what I wanted to achieve. So when I first started, I was like, right, by the end of 2023, I'd like to have a net worth of £100,000. I set a very challenging target that I'm obviously not close to at the moment, in hopes that if I don't reach it, at least I've tried as hard as I possibly could and I've made a dent in that figure. I then said by the end of 2029, I don't know why it was the end of the year and not just 2030, but by the end of 2029, I wanted to have a net worth of £1 million. Now, the goal for this was financial independence, having the flexibility in approach and going, you know what, I'm not liking what I'm doing currently. I have £1 million in stocks and shares that can give me, an annual income with maybe a 3% rule of 30K a year. That's enough to survive. I could move to, let's say, a third world country or maybe Southeast Asia or something. I can chill there for a bit and start building on a business. Lately, however, I've kind of removed sort of the wealth targets in that regard, and instead have kind of looked at what I'd like to do with my time. So by having, let's say, a certain amount of money, I've then got the freedom to say, okay, I no longer need to work in a career. I can focus primarily on my own business. So now, to drive actually the increase in my portfolio, I'm moving more of my cash flow, instead of investing it every single month and investing, let's say, £1,000 a month, I'm pulling £500 of that money and going, right, how can I best reinvest this into my own online business and generate longer term returns, so that over time that business can cash flow enough sums of money so that then it could be reinvested into the portfolio to hopefully compound at a greater rate. So that's sort of the approach and how it's changed now, because I can't remember what it's called, but I think it's some kind of a bias that where you think what you want now is what you'll want in 10, 15 years. And in reality, you end up coming to the conclusion that even what I'm saying now might not be what I want in 7 years' time, for instance. But it's good to kind of have a goal in mind or a picture of where you want to be, or at the very least where you do not want to be. So you can either work to achieve that goal or work to avoid being where you do not want to be. And at least then you can start making some steps in the right direction in the aspects of life that are required in order to achieve that.
Yeah, yeah. Do you have any, you said like starting your own or scaling your own businesses and like online businesses. Do you have any like ideas or anything you've maybe started to work on already?
Yeah, yeah. So without revealing too much on one aspect of it, which I can't say too much about, obviously there's the number one, which is the most obvious to anyone probably watching this, is that obviously I do have a YouTube channel and that generates money through advertising on the ads on a video, monetization. It did before create an income through affiliate links, although I've had some problems with that in the past because companies can pull that at any point. So I thought, you know what, if I'm going to grow a business, I want to do it organically. And one of those is focusing on ensuring high content quality, focusing on delivering value to the viewers that watch. But also now I've started to take another approach in that I've got the YouTube channel, I'm going to focus, put my time into it. But I also write weekly detailed stock analysis on different companies in the UK. So I've only been doing this for the last 8 weeks or so. So I'm trying to build up a bit of a track record, but it's on Patreon, for instance. And I'll go into detail on a company, let's say Tesco, for instance. I'll talk about their business model, their industry, their biggest competitors, threats, risk analysis, for instance, and draw out some growth opportunities in the company. For example, you could argue that Tesco has a huge property portfolio in which they have assets, I think, of about £15.5 billion in property value. When you combine that with the retail cash flow of their stores, and you can ignore the bank in this point, you can kind of work out, okay, there's a good value to be had here. Tesco could utilize this property portfolio to either disrupt competitors that are nearby, Or alternatively, they could use this to mix and change what's currently, or the rent they're currently making from it. So, for instance, they could have a lot of commercial real estate where they've got shop fronts, but they could say, actually, we would like to have a mixture of residential, commercial, and it kind of creates a blend there where they have a little bit more of a consistent stream. So, in each of these reports, for instance, I try and go into almost excessive detail. And I hope that by continuing to do that on a weekly basis and by focusing on the quality, the format, the design, everything like that, that eventually there's enough value there for someone to go, you know what, I'm going to go join that Patreon. I'm interested about X company and I do research there. So that's currently like my primary focus in business growth, aside from the YouTube channel. And there is a third topic that I'm trying to work towards. It's in the planning stages at the moment, but I can't reveal too much about it as of yet. But yeah.
Yeah, how do you find the YouTube, like managing and running your own YouTube channel? I mean, I think every social media platform has its own unique, algorithm, and do you find that people sometimes leave comments which are negative? Uh, like, how do you find like managing the community and constantly creating like new content as well?
Yeah, so funny enough, I pretty much a majority of the time is either a really positive comment or a really negative comment. So I've kind of just learned to just sort of tune it out. I do read every comment in that regard, but it is, I suppose, a challenge in that regard to build up a YouTube channel and maintain a community. One of the approaches I had to make, for instance, was saying, okay, look, I'm spending a lot of time trying to react or respond to every single comment. I've not got the time or energy to do this anymore because I work a full time job, a part time job, and also run this YouTube channel. So it's a case of going, okay, I can't put that energy in there. But in terms of actually having a YouTube business, I think it is very challenging when you first start. But once you start to get a foot on the pedal, on the throttle, on the gas here, you start to build a better understanding of what the viewer is after, especially as someone that watches YouTube myself. And you can kind of use those strategies and trends to go, okay, how can I find or how can I target this certain consumer or viewer? This certain viewer is of a certain demographic, for instance. Okay, how can I tailor to those expectations? So, for instance, a majority of my audience is actually older than me. So, what I'm trying to do is go, okay, look, I'm a younger guy. I want to have a different opinion than perhaps a majority of others. And I'm not going to be afraid to say that. But I'm also going to say it in quite a professional and coherent format so that these individuals might find interest in it and they might go, okay, let's say I'm 40 or 50 years old watching this video, and it might be a case of going, okay, I really think that Lloyd's Bank is an opportunity, but actually I've been looking at this guy called Ozbourne Foreman on YouTube. He's much younger and he's going on about how Lloyd's Bank might not be an opportunity. I think that differential there is quite key, and it allows for almost a unique advantage. And I think regarding YouTube as a business, I think everyone should have their own sort of personal brand or business. I think everyone should look to be growing one because having that kind of experience and skill set is critical, especially if you can do it at a younger age. And you might go, okay, look, I've tried to build a TikTok account. It hasn't gone well. But there's going to be lessons that you've learned from doing that that could be adapted elsewhere. I think I remember reading a stat somewhere, and I'm not going to be very accurate on this, but I believe somewhere between 35 and 40 is the average age that a startup is formed. Now, if you can get ahead of that curve and have your own side hustle or business at a younger age, you are ahead by definition of the average. There's certainly a lot of benefits that can be gained to do that. And I'm sure you've seen the same, for instance, through running your Instagram and your YouTube, right?
Yeah, yeah. I mean, I've been doing it for over 2 years, like consistent posts, nearly pretty much every single day for 2.5 years. Like, and it took hundreds of posts to finally get some traction, but like I stuck with it for a long time. And sometimes people, I think you always get some negative feedback once you start reaching the wider like mass market of people who are not people who are from outside of the investing and finance niche as well. Like people saying like, oh, he's just another Instagram guru who's like 20 years old, has no experience. Why is he telling other people how to manage their money?
Mm.
Like, why should he tell people how to invest? Like, isn't the stock market going to zero? Um, like, isn't it super risky? Things like this. Like, I think it's inevitable. Like, once you start going viral, that you get people like that, right?
Definitely, yeah. For instance, some of my, let's say, haters are some of my most loyal viewers in turn, because they turn up every video to say something that's normally really funny in kind of like an outlandish sort of way. And they're saying that I'm absolute rubbish, that I should sell my stocks and just run for the hills kind of thing. But it's like the same sort of element there, that as you do something, you've almost got those crabs in the barrel. So if you're that one crab that's escaping the barrel, you've got a lot of them trying to drag you down and pull you back in. So in that regard, it's kind of going, okay, you know what? This is a hateful comment. What's kind of their point behind it? Or it might just be, actually, I've evaluated the source of who's written this comment. Unfortunately, I'm able to look at their YouTube channel and I can see their name, I can see who they are, and I can kind of go, you know what? Well, they're saying quite a lot of hate here, and I can see why. But at the same time, I've now evaluated the source, and I don't think they're that reliable based on. You can go into quite some depth in that regard. I'm not going to get too much into it, but if you wanted to, you could definitely look at these kind of people and you can kind of see that perhaps they've got a certain bias towards one thing or another. So it's kind of a way to sort of say, and like investing, actually, it's kind of just to filter out the noise. For instance, like the news and the media, there's a lot of distractions, a lot of scary headlines as well. By sort of just sitting there and going, you know what, I'm not even going to just look at the headlines and just avoid it. You can kind of do the same thing with YouTube in that regard. I read every YouTube comment, even if it's hateful, and I'll take it at, I'll at least try and interpret it. But at the same time, I don't react to it. I don't get an emotional impulse from like a headline would on a stock that I might own, for instance. But yeah,
Yeah, I want to speak a little bit about like investing in. I know I think you're mostly investing in the UK market, right? Do you think
yeah.
that are you seeing more opportunity in UK stocks? I think that maybe the UK market isn't as um like recognized in terms of like the valuations tend to be much lower because the companies are seen as almost a bit slower growth. Um, do you
hmm
think that do you think the UK market is a bit undervalued in that sense?
So at first, I did believe that perhaps there's opportunities that are unique to the UK, and the fact that the stocks had seen quite a well, they saw quite a, what is it called, discount relative, due to the fact of Brexit, followed by the pandemic crash in 2020, which is kind of like the perfect storm. And so I did believe that, okay, there's some value opportunities here. When you combine that with the idea that there's less investment analysts covering UK stocks, just by nature of the popularity of the US markets, it does seem that there is potential in the UK to find some undervalued stocks for what they do. That said, I do also believe that if you want a quality business that's going to grow longer term, whilst there are some and maybe quite a large amount in the UK that are obviously going to be around, I wouldn't filter by specific geographical location, because chances are these days, if you're looking at a company that's got a market cap of greater than £1 billion, they're probably in some way diversified geographically. Unless you're like a house builder that's native to the UK, for instance, chances are you've got a business like, for instance, that of Tesco, that's got some operations in Europe, did have operations in Southeast Asia, and they have almost got I would nearly say a global geographic reach. But of course, there's quite more limitations with Tesco in particular. So it's kind of going and weighing up and saying, okay, well, I like the UK markets. I think I can have a greater understanding of the UK markets. At the same time, I fell for something called patriotic bias, in that I felt the UK businesses could outperform that of the US, when in reality, I don't think it particularly is quantifiable in that regard. There might be businesses that are better in the UK, but I think realistically, going forward, to sort of look and keep an eye on all markets could be perhaps the best approach.
Yeah, and I think the UK, like with the inflation and interest rates, everything, the UK economy is not in a amazing place right now.
Mm.
Um, but I think it's the same across a lot of markets. Um, uh, do you think I want to touch on like when new investors are trying to identify like good stock or good investment opportunities, um, what kind of things should they be looking for when like looking for a good investment?
For a good investment, I think the best way to sort of answer this question would be to sort of almost set a few key rules and sort of stick to them. I think it's very important that you find a business of quality. So, identifying a business as, for instance, Warren Buffett and Charlie Munger would say, with a moat. Now, that doesn't have to be that complicated. It might just be, okay, this business has a large market share because the product they offer has a unique selling point. The unique selling point adds value to the consumer, and the competitors aren't able to replicate. I think that's very important. In fact, probably the most important thing of individual stocks and shares is finding a business with a unique competitive advantage. Then it's a case of going, okay, what is the quality of the balance sheet? What about the financials? So, looking at the balance sheet, do they have much debt? Do they have cash available? So, I like to see typically companies, especially as a new investor, I find it quite simple, especially on something like Simply Wall Street, where you can just look at something and go, okay, balance sheet, what's their debt? What's their cash? What's their equity? What's the debt to equity ratio? How much cash do they hold overall? Is the cash greater than their level of debt? Brilliant. That means that they're able to pay it off if needs be. If you want to go to a little bit more depth than that, you can look at their financial growth, revenue, earnings, and free cash flow. You could look at free cash flow and say, do they have enough free cash flow to pay off their debt? If they don't, how many, if in theory and obviously unrealistic, how many years would it take them to pay that off? So that then you're kind of aware and go, okay, look, it takes them 4 years to pay off this debt. That might be quite a lot. But if they have, exceeding levels of cash on the balance sheet, there's perhaps an advantage there. I think once you've obviously found a business with a unique advantage, you've looked at the quality of the balance sheet and the financials. I think then the next important thing really to look at is valuation and identifying a company that is not only ticking those boxes, but is also at a good or at least fair price. A mistake I made as a new investor in particular was going, oh, wow, there's some fantastic companies available. Let's say Games Workshop, for in instance, right? They've got a great moat because it's very hard to replicate that because they have so much intellectual property and stories and characters. It's so hard for any new company to sort of immerse that kind of group into that, especially when they've got over 40 years, I think, of intellectual property. It's very challenging for a company to get involved. However, I think back pandemic time, I think Games Workshop was trading at quite a high premium. I think it was in the 30s of a price to earnings ratio, which obviously has come down into line over time. I think the shares peaked at something like £120. It dropped all the way back down to about 80 odd. I think it's settled at about £93 a share at the moment. And it's going then, okay, the valuation of this company, it's a great company, but the valuation's too high. And I like to use Peter Lynch's approach where it's a case of, okay, what is the earnings growth rate versus the price to earnings or a price earnings growth ratio? If that ratio, I think, or if you've got a greater earnings growth than the price to earnings, so if it's 22% earnings growth per year in the past and is possible in the future, and it's greater than their 18 price to earnings ratio, I think that's a good indicator. Now, these, whilst I might say they're rules, and I think the first one in particular about having competitive advantages and a big moat is the most important, I think they can be quite flexible as well. You can have businesses with high levels of debt, but they're actually reducing it over time. They've got decent cash flow and can cover it as time goes on. But I think that's when things start to get a bit more complicated, and that's where you've really got to start researching and understanding in order to have conviction in these sort of companies. I'm not sure what you would think in this regard, for instance. So, as a new investor, what's their best approach, really? What would you go for? What would you say?
I think like a lot of mistakes I see new investors make, like and the mistakes that I made myself was like trying to focus too much on the short term like share price movements, trying to time the
Mm,
share price, trying to get in and out of companies because you're anticipating something that's going to come. Like I think everything whenever you buy in a stock, you should be looking at, would I be okay with holding this stock for 5 years if I couldn't buy or sell anymore? Like, am I 100%, well, not 100%, but am I positively like confident that the management team, the vision, is there a plan for how the revenue is going to grow?
mm,
And obviously, as you said, like if the valuation is fair, then that should give you the confidence that okay, 5 years from now, if everything, if there's no black swan event, then the share price should be in a higher place. Therefore, that you can be confident in holding it through the dips. So I think a lot of investors, unfortunately, will sell on their first dip, maybe because they are panicking when they see their portfolio value drop, or they think, okay, this stock's not performing, I'm going to sell it and go into a different stock. But in reality, as an investor, you learn that actually like stocks going down is completely normal.
Mm,
Um, and in fact, like when stocks go down, it's probably a better time to actually buy more. Um,
potentially.
so yeah, I think building a long-term mindset is like something that you have to get your head around. Like being okay with the dips as well. Um, yeah, is there any other mistakes you think investors should avoid, or any mistakes you think like I think there's plenty of mistakes I can reflect on that I've made myself. So anything else you think that like investors need to avoid?
Aside from, say, valuation, for instance, I think probably the greatest mistake I've made is a combination of either, or even in actually in combination together, is the fear of missing out and buying the dip. So buying the dip is quite a popular concept. The idea is simple. Shares drop by 20%, there's an opportunity, it's a dip. By buying at that price, if it rebounds, hey, look, you've made money. In combination with emotion or the fear of missing out, you might be looking at what you consider to be a great investment. It's dropped 20% in value. You think there's a blinder of an opportunity. So in that case, you're going, okay, I'd love to buy. And then you buy yourself a position. The next day, it might drop by a few more percent. You're going, this is a screaming valuation. I really want to buy shares of this. And eventually, this kind of becomes sort of a negative loop because you end up averaging down and buying the dip mainly out of emotion. So, in fact, I've done this in particular, and this attributes to pretty much a majority of my overall total losses in my portfolio, which I think at the moment represent about 40% of my total portfolio value. And that was primarily, well, I mean, there's a whole other risk that meant this happened, but the main problem was is that what I was doing with Boohoo in particular is I was going, okay, look, the shares have dropped to £2.40 a share. They've had some modern day accusations of unfair practices in the workplace, and that they've been reported of underpaying some of their suppliers on an hourly basis. ESG concerns, huge amounts of media against it. And I remember shares dropped on that day from about £4.40 to £2.90, and I mean, it dropped even lower than that. And it sort of rebounded, and I thought I bought a bit at like £2.20. I was like, this is fantastic. Shares have gone back up to about £4. And then as they started dropping down, I'm going, okay, you know what? There's an opportunity here. Shares have dropped to £3.20. That's a great time to buy more. I think the share could be worth about £4. And truthfully, what ended up happening over, especially in hindsight, if you know now that the shares of Boohoo are around about 42 pence a share, then that seems quite ridiculous. But what ends up happening is on the way down, you go, okay, look, the shares have dropped 40% now. There's a huge opportunity. I could buy now. And if it recovers to £4, if it recovers, then great, I've just made a fantastic return on investment. But because you kept buying down and sort of buying that dip per se, it meant that I had overexposed myself to that position and built up such a large stake in Boohoo that attributed to my overall losses. And I think as a new investor, I think it's very easy to make that mistake because you're sort of trying to get the most value for your money. So when you see one of your holdings drop by a high amount, you're thinking, great, this is a fantastic time to buy. It was worth this price. Therefore, I can make money from it. I would imagine you'd agree as well, right? Because you hold shares of Boohoo too, although I don't know how well or what your performance is on that, for instance, and how that impacts your portfolio.
Yeah, I've been following this, the stock price movement quite closely because I was uh fortunate, and I remember during like 2020 and 2021, it had those massive dips that recovered really quickly, and I was
Mm,
lucky to buy shares really low, sell a percentage of the position for a big profit, and then do it again. Then when it started to dip again, I thought, well, this is going to be a repeat of last time, and the media are slamming it, the stock price is dropping, it's going to recover super quickly, is what I was thinking in my head. So as it kept dipping more and more and more, I kept buying more and more and more shares, and the dip unfortunately just kept dipping, kept
mm,
dipping. At that point, there's only so much cash, you know, you can put into a stock before it becomes like too overweighted in your portfolio. So I
yeah.
think I got my average to like £1 10p or something like that.
Okay, yeah.
Um, but obviously it's failed to recover as of yet, and we know like some of the problems they've been having. Uh, but I do think, do you think as well like Boohoo gets a bit of an unfair rep in the media, and the coverage of it seems to be almost always negative, and it does harm the share price quite a bit when you see these like media reports and articles like slamming it constantly, and they're sometimes a bit biased towards like representing it. Like the recent earnings, for example, is all highlighting the negative aspects, not the
Mm,
some of the things that weren't actually that bad.
yeah,
Do you think it's
that's
maybe got unfair rep?
That's quite interesting. That I don't know if I'd say if it was unfair or fair per se, because I think that's inevitable. I think these journalists they typically get more clicks and attention from having a negative headline. That said, Boohoo has had a lot of it, and you could say bad publicity is still publicity, and it's still an advantage to the company in the overall awareness. I think they did have a lot, and I think the trouble with it is that the journalists weren't appropriately fact checking what they'd written. Now, recently, for instance, I've not seen any problems with this. They're saying, oh, Boohoo's lost 90 odd million pounds. Fine, that's true, but it's almost misleading to a regard because you'll read the headline, you'll go, oh no, I'm holding shares of Boohoo. They've lost 90 million pounds. There's a concern there. In reality, when you look into it and you look actually at their cash flow, I think they had an operational cash flow of about 120 million pounds. They'd invested about 90 million or something of those figures into the likes of operational capex. They were reinvesting back in the business and making capital expenditures. I think they also acquired a stake in Revolution Beauty, some 16 odd percent stake. And then after that, they'd actually had an operational or they had a free cash flow that was positive. So they were unprofitable, yet they had a positive cash flow. And that's likely because they were selling clothing at a discounted price that was perhaps lower than maybe what they could make an effective profit margin on, but enough for them to actually generate cash flow for the business and continue operations. So I think a lot of these articles, for instance, were negative, using those negative aspects of it. But in terms of it actually impacting the share price, I think yes, there is an impact there, and I think overall as a collective, especially with the allegations of the unfair practices in the workplace, there was a significant impact to the share price. But at the same time, I think as let's say a long term investor, it would be wise to almost tune that out, be aware of what's going on, and go, okay, is this a concern? Is this an industry wide concern? Or is this a risk that's unique to the company in particular, such as Boohoo? Is Boohoo the only company to be struggling with shipping and logistics? So they're the only online retailer to be struggling with high levels of returns. In reality, the chances are it's not the case. So it's going, okay, I can see this negative headline, but actually it's shared by others in the industry. I understand that, and therefore I'm going to almost tune that out. And I think as a new investor, as we were talking about earlier, I think it's so easy to sort of get caught up in all of the financial news and just like, oh, cool, I'm investing in individual stocks and shares now. I'm going to chuck on CNBC or something. I'll put something on in the background and watch some related news and keep up to date. But I think what ends up happening is it kind of manipulates emotion and it then forces you to make almost illogical decisions in that regard. And I think Boohoo is a great example of that overall. I think obviously you might have shared the same outlook with that, especially with the unfair practice back in June 2020, was it?
Yeah, yeah. I think I still believe in like the potential in the company. I think my only regret is buying too heavily to the point where now I don't want to buy any more because I don't want to make the position any larger. Do you still have the confidence that the company will recover? And do you think maybe the share price was overvalued? So maybe the share price won't return to £4 for a while, but maybe we could get back up to like £1.50, £2. Do you think that's realistic?
I think what is realistic is that it is overall a good quality company, in my opinion. I definitely bought a way too high of a valuation, and that was before I took that into consideration. And that's why valuation takes such a large portion of my strategy now. It's vital. You can find a good quality business, but a good price is another thing. And in that regard, Boohoo, I think actually was trading at something like 50 times price to earnings back in that time. In hindsight, obviously looking back, it's easy to identify that and go, that was kind of stupid of me to be buying at that price. And so while I don't think it's possible, and at the moment for shares to go to that, let's say, £4 region, I think at the current price, and even where my average is, I would say in the next 3 to 5 years, I think my average would be comfortably beaten by some margin. Now, my average, I think, is about £1.21 a share. I think, provided the company is able to return to profitability, and they've shown a very good step in the right direction, especially compared to ASOS. Although ASOS is also showing a similar initiative in that they are also trying to reach profitability as well. I think that Boohoo is capable, and if they're able to obviously continue the automation of their Sheffield warehouse, which I think is now done. I'll have to confirm that. And then obviously look towards that US distribution center. Once they've got a distribution center in the US, that means they can focus on faster delivery times. I think it said they could reach 95% of the US within 3 days. Obviously, the advantage of Boohoo is that you get the deliveries quickly. By having those quick deliveries, therefore, it would be, I would say, I would have a confident outlook in the fact that they would therefore be able to generate sales in the US, and then with a higher level of volume of their products can generate higher sales and subsequently profits. I think overall, obviously, the balance sheet has deteriorated because when I first invested, they had zero debt, or they had very, very small amount of debt, and they had loads of cash. But obviously, they've acquired huge brands like Debenhams and 3 other brands from Arcadia, especially that stake in Revolution Beauty. So I think there's definitely a chance there for Boohoo to grow longer term. But what I've personally decided is that I've said, right, look, I've invested a significant sum of money into Boohoo. At one point, it represented something like 60 or 70% of my total portfolio. That was poor risk management. My lesson has been learned. Okay, so would I buy shares of Boohoo at the current price if I did not have an investment? And I think I'd come to the conclusion of yes, I would. That said, because I've already bought a substantial portion of shares at a higher price and my average is only 120, which is triple what the current price is, I therefore don't think it's logical to continue averaging down and increase my overall risk exposure to the stock. I've been kind of sitting there patiently and going, okay, you know what? There's no inherent reason to sell this stock yet, but I might reevaluate this in the future. So I've just been keeping an eye on the trading updates and the annual reports and going, okay, is this really negative? Is there a time to sell? I don't think so. Or it might be a case of actually in a year's time, Boohoo might have a positive trade update. And at that time, right, they might be making a profit and the shares might be 70, 80 pence a share. Even though I've missed out on this opportunity to be buying at the 40 pence region, I can at least say, okay, if I am going to buy more shares, I can do it at where the business is in a more comfortable position of profitability, where there's less risk involved overall. That's how I've personally sort of, and how I relate to Boohoo in that regard, in terms of the valuation and the mistake that a new investor can make there.
Yeah, I think I'm in a very similar position. So yeah, what about any other? Is there any other stocks right now that you think are like really good or potential investments that you're looking at, like adding to your portfolio, or are you like happy with the number of stocks you have in your current portfolio?
I think as it stands, I have 6 overall holdings in my ISA portfolio, which is what I talk about publicly on YouTube. I have a handful of other stocks that I won't get into too much detail on in a self-invested pension. I've shown it a few times on the channel, but nothing major. They're small holdings. At the moment, I'm quite comfortable with the number of holdings I have. What I've tried to do is go, okay, if I'm not going to sell down my high exposure positions, what I'll do is I'll invest money and build up the size of the positions around the likes of Boohoo, for instance, so that I've therefore got a less volatile overall portfolio. So originally, my strategy was so risk heavy because I'm at a young age, but it was almost foolish in that regard. So what I'd done is I'd bought loads of Boohoo, and I think at one point I was only holding 2 stocks, which was Boohoo and Games Workshop, which was insanely silly in hindsight. But now I've kind of gone with the approach of, okay, right, if I can, let's say, get a good portion of the portfolio in high quality companies that are perhaps less volatile. Maybe they're a bit more of a higher valuation and they're not going to grow at fast of a rate, but at least they're a bit more stable in the portfolio. I could then look to take on more risk once they've been built up. So I've really been buying into companies like London Stock Exchange Group, Alphabet, MasterCard, some like very large and diverse companies that should do well long term. And by sort of buying into them, I'm sort of lowering my risk in Boohoo without having to, let's say, change the size position of Boohoo. And when it comes to actually looking at new holdings, and if I'm looking at anything in particular, an advantage of doing those weekly reports that I post on Patreon is now that I'm taking I look at companies that perhaps I wouldn't have considered in the first place. So I'm sort of just covering like big companies that I have somewhat of an interest in. And lately, I did a report on Rio Tinto, and I thought, okay, mining and metal industry, that's interesting. There's obviously a lot of concerns there. It's a cyclical business. You've got geopolitical problems, and so that's definitely a concern. But it allowed me to go, okay, actually, there's a company I'm looking at the moment that is a Platinum Group's metal miner called Sylvania Platinum. The risk is that they're based in South Africa and Mauritius, and that they've got high exposure there. And obviously, they're based on a group of commodities that obviously adds another risk there. But by sort of looking at it, and I think they had a market cap of something like 230 million pounds, which is their overall valuation based on the total shares available. Um, and then I looked at the cash on hand. I think they had $120 million, $143 million actually. And you think, wow, that's such a large portion of cash considering they had no debt compared to their relative market capitalization. And they're really profitable for what they do. And so I've kind of looked at that and said, okay, it's a risky investment because it's mining and metal. So if I maximum put 5%, say, into a stock like this and sort of build up a few more positions, the goal is really to have about 7 or 8 stocks maximum and sort of have a balance between all of them. Some paying some higher dividends. Sylvania Platinum, for instance, has a higher dividend. Some being more growth orientated. So perhaps the likes of Games Workshop and Boohoo fit that category. And some being a bit more stable. But a few companies that come to mind in that sort of regard are that I have interest in would be the likes of Halma, would be Rightmove. There's a few others that I can't think of at the moment, but I'm always keeping an eye open for available opportunities. But because the relative position size of, let's say, London Stock Exchange Group, MasterCard, and all of them in my portfolio are still quite small overall, I'm kind of focusing on just increasing my stake in those shares to therefore fix out the mistake I'd made earlier in the portfolio. But yeah, do you think there's any good opportunities about anything that, let's say, a viewer could find useful or to take a look at, perhaps?
To be honest, I haven't been adding too many stocks more recently. I think because the market has recovered a little bit from the previous dips. Um, I still, so yeah, I'm not adding too many stocks to my portfolio recently. More so just holding the current positions I'm in. So um, yeah, not really looking at anything right now. But
Do you hold quite a fair amount of stocks? I don't know. I'm not sure too much on your portfolio. Do you hold like 10 or 20 or even less or more?
I think I'm about 15, but some of those are quite small. I think I have about 10, which are like core holdings.
Hmm.
A mixture of like US, UK, um, stocks like Google, Disney, Boohoo, and a couple of other ones I like. But um, yeah, about 15 positions. So
Okay, yeah.
yeah, I think um, unless there's anything else you wanted to touch on, I think we've been going for nearly 50 minutes. Um, do you think
Yeah, I
there's
think
anything
we've
else?
we've had a quite a good session here. I think we've gotten quite a good discussion going there. I think realistically, if I was a newer investor watching this, I think there's quite a few points here to sort of take away. And even if you, for instance, look at my results and how I haven't done successfully at all, at least by sort of avoiding the approaches I've made in the past, hopefully, let's say a newer investor can learn from it. And so I think there's a good bit of value in this one. So I haven't got anything really to add to that at all.
No, yeah, I think this will be very helpful. I think it's been a good conversation. So where can people find you uh, on YouTube and any other platforms?
Yes, so if anyone wants to find me at all, I'm on YouTube under the same name, so just search Osbourne Foreman. I know I didn't come up with my first name, it's quite difficult to spell. I apologize, but hopefully you can find it. And if you're interested in the weekly reports, I write, I'm also on Patreon under the same name, but I'm sure you'll be able to find me if you at least try and spell the first name correctly. I struggle myself sometimes, but yeah,
Yeah, brilliant. I appreciate you coming on. So thank you very much.
it's been great. I appreciate it too. It's been a good chat.